Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They're commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. We haven't talked about commodities in a while, and with them recently correcting so significantly, I felt it important to bring our focus back to this major long-term opportunity. We first started beating the commodity supercycle drum in 2020 with the initial video shown here that can be found on our YouTube channel. We fully expected it to clearly show itself in 2021. As you can see from this chart, that is exactly what did occur in a very dramatic fashion. Frankly, it was even stronger than we felt it would be initially. Commodities overall quickly reached our initial overhead resistance zone, exploding through it before reaching our yellow overhead resistance zone. We've been experiencing a to-be-expected consolidation since then, with likely more still to come. We are expecting the consolidation to minimally test the 12-month moving average shown here in red, maybe more, before reversing and going higher. We'll get into the drivers behind this in a moment. First, we need to appreciate that the violent lift in commodities we have witnessed, as well as the current geopolitical changes we've been writing about in our newsletters, are only further confirming our belief in the commodity supercycle. It is real and will be a dominant investment play this decade in our view. The current pullback should be seen as an opportunity to broaden your overall exposure to commodities in a very targeted fashion. Not all areas should be expected to move together. It is a big sector. We fully expect the commodity supercycle to mirror the developments we are anticipating in seeing with inflation, the US dollar, fiat currencies overall, and global growth. We just recently released this schematic laying out our expectations for inflation to unfold in 3 phases. We refer you to our latest newsletter entitled What Everyone Has Seriously Wrong About Inflation for further details. Here we have overlaid our expectations for the major commodity supercycle legs. We will go through it in a moment, but to better understand this chart, we first need to understand the global geopolitics currently at play to understand our expected developments for the commodity supercycle. We have talked about some of the geopolitics in prior videos and newsletters, but I want to take a slightly different consolidating approach in this session, an approach that my colleague Charles Hugh Smith further surmised after we completed together our last macro analytic video entitled Tectonic Shift, Mercantilism Revalued, where many of you will recall we discussed key changes underway. These are structural changes that are currently having a profound impact on the global economy. I won't revisit them here, but rather how Charles restructured our thinking into another context, but with the same conclusions. I believe this will further clarify why commodities are going to be a central driving development under this unfolding decade. This requires a brief revisit of 4 distinct economic groups we discussed in the last 2 macro analytics videos: colonialism, neocolonialism, mercantilism, and most importantly, importer by choice. You will recall that globalization initially started as colonialization. The colonial powers expropriated commodities by force. The invaders took control of commodity-producing nations via military force and then oversaw the extraction of low-cost raw materials to provide the home markets with cheap materials to feed the colonial powers' value-added manufacturing. The manufactured goods were then sold in the captured markets of the colonial states. Then we had neocolonialism, where the control mechanism wasn't military force, but rather became financialization and globalization. The neocolonial power basically extended cheap credit to the commodity exporting nations, which gorged on this heretofore unavailable banquet of debt. Soon the state and its enterprises were creaking under the unsustainable debt loads, and the neocolonial power swapped assets for debt, buying up the most valuable resources on the cheap or extracting the wealth via interest payments and refinancing. Under neocolonialism, the West has been extracting wealth by the neocolonial model for decades. It suddenly, recently, had a competitor. That was China. China has perfected the neocolonial model with its Belt and Road Initiative, the BRI, which I discussed in quite a bit of detail in the last macro analytics video, which offered low-cost loans to commodity-producing nations, which were in effect mortgages on their most valuable assets, harbors, etc. Once the commodity-producing nations inevitably got into financial trouble, China foreclosed on the loans and took ownership of the resources, ports, etc. In parallel, we need to consider mercantilism. Here we have the optimization of an entire economy for exports of value-added manufactured goods. This is the model adopted by countries such as Germany and Japan in the early 1950s, with national policies designed to subsidize and promote exports to other nations as the primary means of achieving high rates of growth. The priority for U.S. foreign policy was to strengthen the war-torn free market democracies West and East so they would not fall under Soviet control, and so the U.S. enabled these mercantilistic policies to the detriment of domestic producers as one of the costs of the Cold War with the USSR. Now we have the fourth group, the importers by choice. In effect, the U.S. accepted the role of importer by choice, becoming the market where the surplus production of our Cold War allies could be dumped without restriction, all for critically important geopolitical reasons. In the 1950s and 60s, the U.S. market was so large and the exports of the mercantilist economy so modest, this policy of being the dumping ground for allies' exports did not disrupt the domestic economy. Currencies play a critical role in mercantilism. As long as the U.S. dollar was strong and the mercantilist currencies were weak, everyone benefited. The exporting nations' goods were cheap in the U.S. and soon carved out a niche in the U.S. markets. Since the mercantilist economies sought to limit imports, the strong dollar was not much of a drag on their growth. In terms of expanding their tourist industries, the strong dollar was a rocket booster. American tourists flocked to Europe as the dollar went far in both Europe and Japan. To enable its vast industrial production, Japan became a major importer of necessity, lacking oil and natural gas, minerals, ores. Japan imported raw materials and turned these commodities into higher value goods. All three dynamics changed dramatically in the 1970s and the 1980s. The OPEC nations took control of pricing their hydrocarbon commodities at the critical point when U.S. oil production had peaked and was declining. This sent a shockwave of repricing energy through the global economy that helped generate a stagflationary decade of adjustment in higher input prices. At the same time, the external costs of industrialization, pollution, environmental damage, etc., had to be priced in as well via regulations mandating higher efficiencies and the cleanup of industrialized nations' water, air, and soil. In this same juncture, this stream of allies' goods being imported into the U.S. became a flood, creating a permanently large negative balance of trade, i.e. the trade deficit, and undercutting domestic manufacturers as a result of the strong dollar, weak currencies of Europe and Japan. The permanent trade deficits were the result of issuing the world's core reserve currencies, and two, being the importer of choice who accepted virtually unlimited exports from allies. This led to the political revaluation of currencies in the 1985 Plaza Accord, which weakened the dollar and strengthened the currencies of Japan and the European Union. Japan also agreed to limits on auto exports to the U.S., a move that led to Japanese auto manufacturers establishing assembly plants in North America. The enormous success of Japan's mercantilist policies generated Me Too Asian Tiger mercantilistic economies in South Korea, Taiwan, Singapore, Hong Kong, later joined by Thailand, Indonesia, Malaysia, and other nations. The dynamics changed again with the collapse of the Soviet Union in 1991 and the emergence of China as a workshop of the world. Just as the geopolitical reason to remain the importer of choice disappeared, the immense opportunities to boost corporate profits by offshoring production to China beckoned, eventually widening America's trade deficit to new extremes as its corporate profits soared to unprecedented heights. As the mercantilist economy par excellence, China managed its currency with a direct, centrally controlled currency peg to the US dollar. This kept China's currency RMB set at levels that supported its hyper-mercantilistic exports to the US and other developed nations. One often underappreciated reason why the Soviet Union collapsed was the low oil prices in the late 1980s. The Soviets' primary source of export revenues was oil and natural gas, and once the revenues fell below a critical level, the Soviet Union ceased to be financially viable. China's fast-growing economy was soon sucking in unprecedented amounts of commodities, oil, copper, soya, etc. In other words, China became a vast importer of necessity like Japan. Even though China had large coal reserves, much of its highest-grade coal has already been depleted. Its modest oil reserves have also largely been drained. What happens to mercantilistic economies is they become importers of necessity, totally dependent on neo-colonial sources of cheap commodities and import markets open enough and large enough to absorb their stupendous flood of exports. The commodity-producing nations have finally wearied of being strip-mined by the West and East and are starting a long-delayed, unified effort to take control of the resources being plundered by the developed and the mercantilist economies. This is now being fueled by scarcities in commodities, scarcities fueled by many sources, depletion, supply chain disruptions, geopolitical blackmail, etc. As financialization and globalization have reached the point of diminishing returns, they are now in the decline phase. These drivers of global growth are unraveling at the same time that commodity prices are rising in a secular trend and the global economy is entering stagflation. These conditions are squeezing the mercantilist economies as their cost of materials rise while the markets for their exports contract. Another problem with the mercantilist strategy of depending on exports for growth is there's always a cheaper competitor on the rise. So Vietnam and other rising exporters are siphoning production from China and other mercantilist nations. Meanwhile, back on the currency front, the US dollar is gaining purchasing power at the expense of other currencies. This is adding a secondary tax on higher commodity prices as the majority of commodities are priced in US dollars. A stronger US dollar moderates commodity inflation for the US and exasperates it for everyone else using other currencies. A stronger US dollar is also making China's currency less competitive as it rises along with the US dollar due to its peg to the dollar. The power shift is complicated. From mercantilist and importing nations to commodity exports, and from mercantilistic exporters to the issuers of strengthening currency, the US dollar. The mercantilist dependencies on exports for growth, a winner for the past 70 years, has reached diminishing returns. Rather than being a source of growth, it's a source of stagnation. Conventional wisdom holds that geopolitical power is inevitably shifting from west to east. It isn't quite that simple at all. The real shift is occurring between three sources of power that are not so neatly geographic. Those three competing spheres are the consumer importing nations, the mercantilist exporters of products, and the commodity exporters. The commodity supercycle is now fundamentally confirmed. These develops, and what we have witnessed with commodities over the last 2 years confirms to us, at MATA-SII, we have a commodity supercycle that has completed phase 1 of what will be a 3-phase cycle dominating this decade. At least that's our current view. Phase 1 has been a remarkable kickoff that frankly caught the global markets completely off guard, just as the major consolidation is also currently doing. The current dominant driver of commodities is the strength of the US dollar. This, along with the inflation driver, will soon give way to the geopolitical advancements we just outlined. These in turn will eventually give way to global turmoil and financial rebalancing. As such, we therefore currently expect commodities to continue to fall as the US dollar rises, commodities to then rise as commodity scarcity steadily then increase, commodities then to fall as the developed commodities as represented by the G7 fiat currencies fall, Commodities then rise as export restrictions, allocations, and restrictive trade blocks and agreements increase, and finally commodities fall as the global growth craters and a new world order emerges. The reason the dollar has moved up so sharply relative to the euro and yen is very clear. The Fed is tightening monetary policy much more aggressively than the European Central Bank or the Bank of Japan. The ECB has been and will continue to be slower to tighten monetary policy than the Fed because Europe is facing a much more challenging economic environment than the US, given that Russia's war in the Ukraine has driven energy prices radically higher in Europe. The Bank of Japan is reluctant to tighten monetary policy since inflation in Japan remains under control at around 2.5%, and because Japan has been struggling against deflation for decades. With the interest rate being offered on dollars already significantly higher than that being offered in euros and yen, and with that interest rate differential expected to widen much more in the months ahead, it's not at all surprising that the dollar is strong and strengthening. But there's a further reason for the dollar's strength. The Fed has already begun destroying dollars through quantitative tightening, whereas the ECB is not expected to begin QT for several more months, and the BOJ is still carrying out quantitative easing to keep the yield on the 10-year Japanese government bond pegged at 25 basis points. This stark contrast in monetary policy between the Fed on the one hand and the ECB and the Bank of Japan on the other suggests that the dollar should continue to strengthen. If it does, it's likely to have a profound impact on the global economy. Perhaps most significantly, it should put even more downward pressure on commodity prices. It's not just a coincidence that the price of many commodities has fallen sharply during recent weeks as the dollar has strengthened. As dollar strength has gained momentum in recent weeks, many commodities are experiencing a brutal sell-off. Though there is obviously a fair bit of speculation shown here, the unfolding phase are likely to emerge in some fashion, as represented here. In addition to putting downward pressure on commodity prices, a strong dollar tends to depress global economic growth, corporate earnings, and stock market valuations as well. A strong dollar is bad for emerging market economies for a number of reasons, economies that are already facing very difficult problems. First, we've seen a strong dollar push commodity prices lower, and that inflicts significant damage on numerous countries across the developed world that are heavily reliant on commodity production. Dollar appreciation also makes it more expensive for countries in the developed world to buy the US dollar they need to service their foreign debt, making debt defaults more likely. Emerging market problems can spread. Next, the strong dollar makes imported goods more expensive, thereby adding to domestic inflationary pressures. And rising inflation frequently forces emerging markets central banks to increase interest rates, resulting in higher borrowing costs, which negatively impacts economic activity in those countries. Problems in emerging markets frequently spread to the advanced economies. For instance, weakness in emerging markets tend to contribute to a slowdown in world trade, with damaging economic consequences for the developed economies as well. Moreover, emerging market defaults and foreign loan can damage lenders in the more advanced economies, as during the third world debt crisis of the early 1980s. It's bad for corporate earnings. A strong dollar also tends to depress U.S. corporate earnings, since roughly 30% of all the earnings of companies in the S&P 500 index are derived from abroad. There are two main reasons for this. First, a strong dollar makes U.S. goods more expensive and therefore less competitive abroad, but also U.S. corporations earn less when their foreign revenues are exchanged into U.S. dollars. In recent days, Coca-Cola, Microsoft, Salesforce have all warned of the negative effects of the strong dollar is having on their financial results. We have outlined in our writings the mounting pressures towards global de-dollarization and the changing needs for reserve currencies in a multipolar world order. We have also discussed the thinking of Zoltan Polzar's new Bretton Woods III emerging economic order. I won't spend time on these here, but they all lead to the same conclusion about the role of commodities going forward. The signs couldn't be clearer, from underinvestment in commodities to long-term cycles to shorter-term cycles. We are at the early stages of a major commodity supercycle that you need to continue to recognize and prepare for. As I said earlier, it's likely not to be as we've outlined here, but unfolds slightly different with actual events. We believe it would be valuable to use this schematic as your starting point to better understand the unfolding roadmap ahead. As I always remind you in these videos, remember, politicians and central banks will print the money to solve any and all problems, until such time as no one will actually take the money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and global policy paralysis. I'd like to take a moment as a reminder, do not trade from any of these slides. They're for educational and discussion purposes only. As negative as these comments often are, there has seldom actually been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor to assist you. So until we talk again, may 2022 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.